Look, something fundamental just changed in the precious metals market. And if you're holding gold or silver right now, you need to understand what's happening, because this shift is going to determine whether you're positioned correctly for what comes next. For years, we've watched gold and silver move in predictable patterns, retail investors buying on dips, hedge funds playing momentum, the usual suspects doing the usual things. But in recent months, something different started happening, something that changes everything about how these markets work. Central banks are buying gold at a pace we haven't seen in over half a century. Not just buying, accumulating, hoarding, and they're doing it quietly, methodically, like they know something the rest of us are just starting to figure out. Think about what that means for a second. These are the institutions that print money. They control interest rates. They manage entire economies. And they're converting their own currencies into physical gold at record levels. What does that tell you about their confidence in the system they're running? The numbers are staggering. Central banks added over 250 tons of gold through October alone. That's not normal market activity. That's preparation. And when you dig into who's buying, it gets even more interesting. It's not the traditional Western central banks leading this charge. It's emerging markets. China, India, Turkey, nations that are actively working to reduce their dependence on the dollar. This is phase 3. And if you don't understand what that means, you're going to miss the biggest wealth transfer in modern history. Let me explain how we got here. Phase 1 was the foundation. After the 2008 financial crisis, gold went from around $800 to over $1,900 by 2011. That was the fear trade. People saw the banking system nearly collapse, watched governments print trillions, and rushed into precious metals as a safe haven. Classic crisis response. But then it faded. Gold spent years consolidating, drifting lower, boring everyone who bought at the top. Phase 2 started around 2019. Gold began climbing again, but this time it was different. It wasn't just retail investors scared of the next crash. It was institutions quietly building positions. Central banks started increasing their purchases. The smart money was accumulating while everyone else was distracted by tech stocks and crypto. Gold broke through $2,000, then $2,100, setting new records. But the real story wasn't the price. It was who was buying and why. Now we're in phase 3. And this is where everything accelerates. What makes phase 3 different is the structural shift happening beneath the surface. This isn't about fear anymore. It's about the fundamental architecture of the global financial system being rewired in real time, and precious metals are at the center of it. Basel III regulations just changed how banks have to treat gold on their balance sheets. For the first time, physical gold is classified as a Tier 1 asset, the same as cash. Think about what that means. Banks can now hold gold as a core reserve asset without any risk weighting. That's a game changer. It means gold isn't just a commodity anymore. It's officially money again in the eyes of the global banking system. But here's where it gets really interesting. While Western financial media barely covered this change, Eastern nations understood exactly what it meant. They've been preparing for this moment for years. China has been building its gold reserves quietly, likely holding far more than they officially report. Russia accumulated over 2,000 tons before sanctions hit. These nations saw this coming and positioned themselves accordingly. The BRICS nations are now openly discussing a gold-backed trade settlement system. Not a gold-backed currency yet, but a mechanism where gold serves as the neutral settlement asset for international trade. No dollars needed, no euros, just gold moving between central bank vaults to balance trade flows. If that system goes live, and all signs point to it happening sooner rather than later, the demand for physical gold will explode. And here's the thing most people miss. There isn't enough gold to go around if everyone who wants it tries to get it at the same time. The entire global gold market is surprisingly small. All the gold ever mined in human history would fit in a cube about 22 meters on each side. That's it. And most of that gold is locked up in jewelry, central bank vaults, and private holdings that aren't for sale at any reasonable price. The gold available for trading, the stuff that actually moves through markets, is a tiny fraction of that total. And right now, we're watching the available supply get absorbed by buyers who aren't planning to sell. Central banks don't flip gold for quick profits. They accumulate and hold. When they buy, that gold disappears from the market permanently. This creates a supply squeeze that most investors don't see coming until it's too late. The price can stay relatively stable for a while as paper gold trades back and forth on exchanges. But underneath, the physical metal is being drained from the system. And when the paper market finally has to reconcile with physical reality, that's when prices gap higher violently. We've seen this movie before. In the 1970s, gold went from $35 an ounce to over $800 in less than a decade. But that wasn't a smooth ride up. It happened in explosive bursts. Long periods of consolidation followed by rapid price spikes that left most investors behind. The people who made life-changing wealth weren't the ones trying to time every move. They were the ones who understood the structural shift happening and positioned themselves early. Right now, we're in a similar setup. Gold has been consolidating in a range while the structural changes happen beneath the surface. Central banks accumulating, Basel III implementation, BRICS trade settlement discussions, de-dollarization accelerating. These are the foundation being laid for the next major move. And silver? Silver is even more interesting because it's caught between two worlds. It's a monetary metal like gold, but it's also an industrial commodity with applications in everything from solar panels to electronics. That dual nature creates a unique dynamic. For the first time in modern history, central banks are buying silver again. Not in huge quantities yet, but the fact that they're buying at all is significant. Silver lost its monetary role decades ago when nations moved away from bimetallic standards. Central banks sold their silver reserves and forgot about it, but now, 3 central banks have started accumulating again. That's a signal. They're recognizing that silver, like gold, has a role to play in the new financial architecture being built. On the industrial side, silver demand is exploding. Solar panel production alone is consuming silver at unprecedented rates. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments worldwide are pushing requires massive amounts of silver. And here's the problem. There isn't enough supply to meet that demand at current prices. Silver mines are struggling. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices are low, silver production drops because it's not economical to run the mines. We're heading into a situation where industrial demand for silver could exceed available supply, forcing prices higher just to incentivize more production. And that's before you factor in any monetary demand from investors or central banks. The gold-to-silver ratio tells an interesting story. Historically, this ratio has averaged around 60-1, meaning it takes 60 ounces of silver to equal the value of 1 ounce of gold. Right now, that ratio is still elevated compared to historical norms. If silver catches up to gold in this bull market, the percentage gains in silver could be substantially larger than gold. That's why serious precious metals investors hold both: gold for wealth preservation and stability, silver for leverage and upside potential. But here's what most people get wrong about precious metals investing. They think it's about predicting the exact top and bottom, trying to time every move. That's not how generational wealth is built in this space. The people who made fortunes in gold and silver did it by understanding the macro trend and staying positioned through the volatility. Think about someone who bought gold in 2005 at $450 an ounce. They watched it climb to $1,900 by 2011. Then they watched it fall back to $1,050 by 2015. If they sold in panic during that decline, they missed the next leg up that took gold to new all-time highs above $2,100. The winners were the ones who understood that the long-term trend was intact despite the volatility. We're at a similar inflection point now. The structural changes happening in the global financial system are creating the setup for the next major move in precious metals. But it won't be a straight line up. There will be pullbacks, consolidations, moments where it feels like nothing is happening. That's when most people lose patience and sell. And that's exactly when the smart money is accumulating more. Let me tell you what's really driving this shift. It's not just about inflation or currency debasement, though those are factors. It's about trust. Or more accurately, the loss of trust in the current system. The dollar has been the world's reserve currency since World War II. That status gave the United States enormous advantages. We could print money to fund deficits and export that inflation to the rest of the world. Other nations had to hold dollars to conduct international trade, creating constant demand for our currency. It was an incredible privilege. But that privilege is being challenged now, not by military force or political pressure, by simple mathematics. The U.S. national debt is over $34 trillion and growing by trillions every year. The interest payments on that debt are becoming unsustainable. At some point, the math stops working, and the rest of the world is watching this happen in real time. China holds over $1 trillion in U.S. Treasury bonds. They're watching the debt spiral and asking themselves a very logical question: Will we get paid back in dollars that have the same purchasing power as the dollars we lent? The answer is obviously no. So what do? They start diversifying. Buying gold, building alternative trade systems, reducing their dependence on the dollar gradually but deliberately. This isn't happening in a vacuum. Russia got cut off from the SWIFT payment system after the Ukraine conflict started. That was a wake-up call for every nation that might find itself on the wrong side of U.S. foreign policy. If your access to the dollar-based financial system can be revoked overnight, you need alternatives. Gold becomes that alternative. It can't be sanctioned. It can't be frozen in a bank account. It's the ultimate neutral asset. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting payment for oil in currencies other than dollars. That's a seismic shift. The petrodollar arrangement, where oil was exclusively priced and traded in dollars, created artificial demand for U.S. currency for decades. If that system breaks down, the implications for the dollar are profound. And what do nations do when they're receiving payment in multiple currencies? They convert some of it to gold for stability. This is the de-dollarization trend everyone talks about, but few people truly understand. It's not about the dollar disappearing overnight. It's about the dollar slowly losing its monopoly status as the world's reserve currency. And as that happens, gold's role as the neutral reserve asset grows. That's what's driving central bank buying. They're preparing for a world where the dollar is one option among many, not the only option. Now, if you're sitting on retirement accounts or savings, and you're wondering how this affects you, let me make it simple. When the world's reserve currency is in transition, wealth gets redistributed. Some people see their purchasing power evaporate. Others position themselves to benefit from the shift. The difference is understanding what's happening and acting before the crowd figures it out. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. The guide breaks down the process, the rules, and what to watch out for. Grab it if you want to explore that option. Anyway, back to what's happening in the markets right now. The paper gold market is showing signs of stress. The COMEX, where gold futures are traded, has seen some interesting dynamics lately. Open interest is high, meaning lots of contracts are outstanding. But the amount of physical gold available for delivery is relatively low. That's a setup for a squeeze. If even a small percentage of contract holders demand physical delivery instead of rolling their positions or settling in cash, the exchange could face a serious problem. This happened before in different markets. Remember the nickel squeeze on the London Metal Exchange? Prices went parabolic because there wasn't enough physical metal to cover the short positions. The exchange had to halt trading and cancel trades to prevent a complete meltdown. That's what happens when paper markets get disconnected from physical reality. And right now, the gold market has all the ingredients for a similar situation. The smart money knows this. That's why you're seeing a divergence between paper gold prices and physical premiums. When you go to buy physical gold coins or bars, you're paying a premium above the spot price. That premium has been widening. It's telling you that physical metal is harder to get than the paper price suggests. That's a warning sign that the paper market is masking the true supply-demand dynamics. Silver shows this even more dramatically. The premium on physical silver has been elevated for years now. Try to buy silver eagles or maple leafs from a dealer. You're paying $4 to $6 over spot price per ounce. That's not normal. In a healthy market, premiums are minimal. High premiums mean physical demand is outstripping supply, even while the paper price stays relatively tame. Eventually, the paper price has to catch up to physical reality. When it does, the move will be violent. Let's talk about what happens next, because understanding the setup is one thing. Knowing how to position for it is another. Phase 3 is characterized by institutional accumulation and structural changes in the market. This phase can last longer than most people expect. It's not about immediate price explosions. It's about the foundation being built for the next major bull run. The central banks buying now aren't doing it because they think gold is going up next week. They're doing it because they know the system is changing and they want to be positioned before the change becomes obvious to everyone. For individual investors, this is the accumulation phase. This is when you build your position methodically, taking advantage of any pullbacks, not panicking when prices consolidate. The people who make generational wealth in precious metals are the ones who accumulate during Phase 3 and hold through Phase 4, which is when prices go parabolic and mainstream media finally starts covering it. Phase 4 is when your neighbor who never cared about gold suddenly asks you how to buy it. That's when taxi drivers are giving investment advice about silver. That's when CNBC has gold bugs on every show. That's the euphoria phase. And that's when the smart money that accumulated during Phase 3 starts taking profits. But we're not there yet. We're still in the early stages of Phase 3. The structural changes are happening. The smart money is accumulating. But the mainstream hasn't caught on yet. That's your opportunity. Here's what you need to understand about precious metals in your portfolio. This isn't about getting rich quick. It's about preserving wealth through a major transition in the global financial system. Gold and silver are insurance against the system breaking down, but they're also positioned to benefit enormously if the system transitions to a new architecture where precious metals play a larger role. The allocation depends on your situation. Conservative investors might hold 10–15% of their portfolio in precious metals. More aggressive investors who believe the transition is imminent might go higher. But the key is having exposure. Because if this thesis plays out, the gains in precious metals will offset losses in traditional assets. And if the thesis is wrong, you've got a small allocation in assets that have held value for thousands of years. That's not a bad hedge. Physical metal versus paper exposure is another consideration. ETFs like GLD and SLV give you price exposure without the hassle of storing physical metal, but they're not the same as holding the actual metal. In a real crisis, you want physical. In a normal bull market, ETFs work fine. Most sophisticated investors hold both. Physical metal as the core position. ETFs for trading around the position. Mining stocks are the leveraged play. When gold and silver prices rise, mining companies see their profit margins expand dramatically. A 20% increase in gold prices might translate to a 50% increase in mining company profits because their costs are relatively fixed. That leverage works both ways, though. Mining stocks are more volatile and carry company-specific risks. But for investors who want more upside potential, quality mining companies can deliver outsized returns during a precious metals bull market. The key is understanding what you own and why you own it. Physical metal for wealth preservation and insurance. ETFs for liquidity and ease of trading. Mining stocks for leverage and growth potential. Each serves a different purpose in a precious metals strategy. Now let's talk about the risks. Because nothing is guaranteed and you need to understand what could go wrong. The biggest risk is that the system doesn't break down, that central banks figure out how to manage the debt, control inflation, and maintain confidence in fiat currencies. If that happens, the urgency to own gold diminishes. Prices could stagnate or even decline as investors move back into traditional assets. That's possible. But look at the trajectory we're on. Debt is accelerating, not slowing. Geopolitical tensions are increasing, not decreasing. The structural problems are getting worse, not better. Betting on the system fixing itself requires a lot of optimism. Another risk is government intervention. History shows that when currencies are in crisis, governments often restrict gold ownership or impose windfall taxes on precious metals gains. FDR did it in 1933, confiscating gold from U.S. citizens. Could it happen again? It's possible. But it's also harder to enforce in a modern global economy where capital can move across borders instantly. And even if it happens, gold held in certain structures like IRAs or held outside the country might be protected. Market manipulation is a real concern. The gold and silver markets have been manipulated before. Banks have been fined for spoofing and rigging prices. When you have a relatively small market with concentrated players, manipulation is possible. But here's the thing. Manipulation can suppress prices temporarily, but it can't change the underlying fundamentals. If anything, manipulation creates better buying opportunities for those who understand the long-term trend. The final risk is timing. You could be right about the thesis but wrong about the timing. Gold could consolidate for years before the next major move. That's frustrating if you're expecting immediate results. But if you understand that Phase 3 is about accumulation and positioning, not immediate gratification, then timing becomes less critical. You're building a position for the long term, not trying to catch a quick trade. Let me give you some historical context that might help frame what's happening now. In 1971, Nixon closed the gold window, ending the dollar's convertibility to gold. That was the moment the modern fiat currency system was born. Gold was $35 an ounce when that happened. By 1980, it hit $850. That's a 24x return in less than a decade. But it didn't happen smoothly. There were massive pullbacks along the way. People who sold during those pullbacks missed the ultimate move. What drove that bull market? loss of confidence in the dollar, inflation spiraling out of control, geopolitical instability. Sound familiar? We're seeing similar dynamics now, just on a larger scale. The debt is bigger. The money printing is bigger. The geopolitical tensions are more complex. If history rhymes, and it usually does, we're setting up for a similar move in precious metals. The 2000s bull market in gold is another example. Gold bottomed around $250 in 1999. By 2011, it hit $1,900. That's a 7.6x return over 12 years. Again, not a smooth ride. There were corrections of 20–30% along the way, but the people who understood the macro trend and stayed positioned made life-changing returns. Both of those bull markets were driven by fundamental shifts in the monetary system. The 1970s was the transition from gold-backed money to pure fiat. The 2000s was the response to the dot-com bubble bursting and then the 2008 financial crisis. Now we're in the transition from a unipolar dollar-dominated system to a multipolar system where gold plays a larger role. That's the setup for the next major bull market in precious metals. The difference this time is the scale. The global debt is measured in hundreds of trillions. The derivatives market is over $1 quadrillion. The amount of money that could flow into precious metals if even a small percentage of that capital seeks safety is staggering. We're not talking about gold going from $35 to $850. We're talking about gold potentially going from $2,000 to $5,000 or higher, and silver, with its smaller market size, could see even more dramatic percentage gains. But here's what most people miss. The real wealth isn't made in the price appreciation alone. It's made in the purchasing power preservation. If gold goes to $5,000 but a loaf of bread costs $20, you haven't really gained much. The real win is if gold goes to $5,000 while the cost of living stays relatively stable or increases at a slower rate. That's when you've actually preserved and grown your wealth in real terms. That's why precious metals are called insurance. They're not about getting rich. They're about not getting poor. In a world where currencies are being debased and purchasing power is eroding, gold and silver maintain their value. An ounce of gold today buys roughly the same amount of goods and services as an ounce of gold did 100 years ago. Can you say the same about the dollar? About any fiat currency? This is the fundamental case for precious metals. It's not speculation. It's preservation. And in times of monetary transition, preservation becomes the most important investment strategy. So where does this leave you? If you own precious metals already, Phase 3 is telling you to hold and potentially add to your position. This is not the time to get shaken out by volatility or lose patience because prices aren't moving fast enough. The structural changes are happening. The smart money is accumulating. Your job is to stay positioned and let the thesis play out. If you don't own precious metals yet, Phase 3 is your entry point. This is the accumulation phase before the mainstream catches on. You're not buying at the bottom, but you're not buying at the top either. You're buying when the fundamentals are aligning, but before the price reflects those fundamentals. That's the sweet spot. The key is having a plan. Know how much you want to allocate. Know whether you want physical metal, ETFs, mining stocks, or a combination. Know your time horizon. This isn't a trade. It's a position for a multi-year trend. Set it up correctly from the start, and you won't be tempted to panic sell at the worst possible time. And understand that this is bigger than just making money. This is about navigating one of the most significant transitions in the global financial system in our lifetime. The dollar's dominance is being challenged. Central banks are preparing for a new system. Precious metals are being repositioned as monetary assets. If you understand what's happening and position accordingly, you'll be on the right side of this transition. The people who made fortunes in previous precious metals bull markets weren't the smartest traders. They were the ones who understood the macro trend and had the discipline to stay positioned through the volatility. They bought when others were skeptical. They held when others were selling. And they profited when the trend finally became obvious to everyone. That's the opportunity in front of you right now. Phase 3 is here. The shift is happening. The question is whether you're going to recognize it and act, or whether you're going to wait until Phase 4 when everyone else figures it out and prices have already moved. Central banks are buying gold at record levels. Basel III has changed how gold is treated in the banking system. BRICS nations are building alternative trade settlement systems. De-dollarization is accelerating. Silver is caught between monetary demand and industrial supply shortages. The paper markets are showing signs of stress. The physical premiums are elevated. Every indicator is pointing in the same direction. This is not financial advice. This is information. What you do with it is your decision. But understand that doing nothing is also a decision. It's a decision to stay fully exposed to a system that's showing cracks. It's a decision to trust that the people managing trillions in debt and printing money at unprecedented rates have everything under control. Or you can take a different approach. You can allocate a portion of your wealth to assets that have preserved value for thousands of years. Assets that central banks are accumulating. Assets that are positioned to benefit from the structural changes happening in the global financial system. Phase 3 is here. The shift is happening. The only question is whether you're positioned for it.